I want to bring in another voice to this discussion right now. That's BMO's Brian Belsky. Speaking of runway, he's raising his S&P 500 target to 7,000 from a prior 6,700. He joins us on the phone right now. Brian, you've been listening to the discussion that we've been having over here about whether it's 1999 or 1997, whether NVIDIA at 30 to 31 times forward earnings is bubblicious or not. What exactly is your view in raising the S&P 500 target? I think I kind of know at this point.
Thanks, Dom, and thank you so much for having us. We really, really appreciate the support. I think all the comments today have been excessively balanced. I believe that bubble is probably the most overused term in our industry. I think to have a bubble, quite frankly, means that you have to have a lot more frivolous things going on. And to keep it really simple, you have to have everybody making money, and I don't think everybody's making money. And let's just say that back in 99, 2000, and I was a strategist at Piper Jaffray during those days, and that was when the man was making money. And who's the man in Wall Street? It's Wall Street firms. And if you take two steps back and take a look at the IPO activity, the secondary activity, and the M&A activity in 99, 2000, it was quote-unquote frivolous. Companies were buying other companies with stock. IPOs were being priced on no valuation, and secondaries were done at very lofty values. Now, valuation, we know, is concerning. We get that. Steve did a great job talking about this is a market that has been discounting valuation, meaning setting it aside. Why is it setting aside? Because the true secular momentum of AI. AI companies, tech companies right now, Dom, are very different than they were in 99, 2000. They have cash. Some of them pay dividends. Some of them have great cash flow. And oh, by the way, from an earnings perspective, the technology sector has become the most discernible, consistent earner in the entire market. So with respect to our 7,000 number, that was our bull case all along. And that's why we said we've reached our bull case in terms of where we think markets are going. And that 7,000 number we first put out in November of 2024. So things are unraveling like we thought they would, and we think the bull market goes on. Lastly, on Jim's case and with respect to 1997, I think 2025 is setting the table for Goldilocks. In the last real kind of consistent Goldilocks period we had it in 2019, but it didn't last as long as it probably should have because of COVID. I believe that 2025 could very well be the table setter for Goldilocks for the next 2 years, very similar to 94 and how it set the table for 1995 and 1996.
All right. So, Brian, good thoughts. I want to bring in now Jason to this discussion. We have some B of A fund flow data. All right. They've just logged what they say is their third highest ever inflow into equities globally in the past 2 weeks. Right. Their private client base, with $4.2 trillion under management, is roughly 65% in the stock market right now, which is the highest level since March of 2022. They are roughly 18% in the bond market, which is the lowest since May of 2022. And they are holding 10.5% cash, which is the lowest since September of 2018. I spoke with Mark Smith, portfolio manager at Wells Fargo Advisors, this morning on Worldwide Exchange, and he cited specifically the roughly $10 trillion in money market cash that is on the sidelines right now. Yeah. Take all of that and tell me whether or not there is still fuel, whether that cash will be deployed.
There's absolutely fuel, Dom, and I think it's a couple of things. One, we talk about this time of year and we talk about seasonality, which really hasn't happened as of yet, right? So I think there's some animal spirits in terms of who has missed out on the rally thus far, who maybe has sold in April that maybe wanted to put capital to work. And then the chase goes on, for year end, which I think is a real thing for people in investor psychology. So we're going into a cutting cycle now. when we heard from Powell, it seemed like there's absolutely 3 cuts. That's what's going to happen into year end. Obviously, there's been some divergence amongst fund governors on where they are as it relates to that. But if I speak to earnings just quickly, we got earnings starting in earnest in 2 weeks. 8.6% expectations in terms of growth. That has been one of the major catalysts that has kept this market up. So I think for a lot of folks out there, as we head into year end, that's a major story that will play a role. And I think that's why investors are where they are and deploying capital as they're looking to do so.
We constantly throw out these numbers from B of A, their flow show and all that, but we never follow up with what the correlation is to market direction. So it's not worth having the conversation and pointing it out other than the wow factor. So I'd love to know what it is. And, if okay, we've seen so much money come in, does that mean it's the end of the rally for this point in time? Or does it mean it's the beginning with more money coming in? So I don't know how to look at it.
Brian, to Steve's point here, it's a good one. But also, if you look at the medium to longer term trend of all of this flow data coming in, the markets do keep going higher. So at the end of the day, we have seen a market that has moved solidly to the upside, whatever the flow show has dictated or anything else. Is that right?
It is right. And, the great Merrill Lynch advisors, which I had the pleasure of working with for so many years at Merrill Lynch during my past, is, they're great advisors. They've got great data. And remember, too, so much of this money has gone into passive, Dom, where some of this is just portfolio diversification. If they own too many stocks or too many particular types of disciplines within stocks, they'll buy S&P or they'll buy value or they'll buy bond, even index funds. And so remember, too, if memory serves me correct, over the last 3 or 4 weeks, we had actually outflows from these people. So these are numbers that we can take a look at for support. I think with respect to the money market data number, that's a pretty big number. And Jason did a wonderful job talking about seasonality. And typically and historically, when the S&P 500 is up 10 to 20% the first 3 quarters of the year, you have an on average rally of something like 6% in the fourth quarter. That's not the reason why we upgraded to the bull case. We upgraded to the bull case because our fundamental work says that earnings are better than everybody thought, and that was the main reason why we remained bullish all year long in terms of revisions getting too negative. And now those revisions are reversing quite strongly to the point where I think earnings are going to be at double digits in 2026.
Okay. Brian Belsky at BMO Capital Markets. Thanks very much for joining us on the phone here. Have a nice weekend, sir. We'll talk to you later on. I want to go back to you, Jim. Given everything that we've heard with the price target upgrade there,